Level 1 begins with a spreadsheet that should have been boring, but by midnight it is quietly trying to destroy someone's career. You are sitting in a regional investment firm in Oslo managing risk for a $2 billion portfolio, which sounds huge until you realize nobody outside this building knows your name. For 11 hours, you have been staring at the same fixed income model, testing what happens if rates jump 150 basis points. You have run this test 47 times before. Tonight is number 48, and this time the model breaks. At first, you think it has to be your mistake. Maybe a bad formula, a wrong reference, a copy-paste error hiding in some dead corner of the workbook. So you go cell by cell, sheet by sheet, trying to find the thing that will let you breathe again. But the deeper you look, the colder your stomach gets, because the error is not random. It is intentional. Someone changed a duration constraint, buried it inside a cell that displays a 0, and left it there like a loaded weapon. The name attached to the override is Ericsson, a senior manager with the kind of confidence people mistake for competence. For 3 weeks, he has hidden $340 million in notional exposure, leveraged into long-dated Norwegian krone debt, wrapped in swaps that only work if volatility stays flat forever. The hedge is supposed to protect the position, but now you can see the truth. It is decorative. It looks responsible from far away and useless up close. Then the central bank drops the statement no one on your floor wanted to see. The new hiking path is aggressive, fast, and completely unforgiving. Your screen recalculates and the mark-to-market loss flashes back at you, $61 million still moving. You stop hearing the office around you. The numbers are no longer abstract. They are alive, spreading through the book like smoke under a locked door. And you are the only one watching it happen. You do not sleep. You open a blank sheet and build the model again from scratch. Because one model can be wrong, and one exhausted analyst can miss something. The second model confirms the first. So you build a third, it confirms the second. Now the problem is no longer the spreadsheet. The problem is what you are willing to do with it. At 2:15 a.m., you draft an encrypted message to compliance and your finger hovers over send. Level 2 begins the moment you press send before fear can talk you out of it. By 7 a.m., compliance has escalated to the board. By noon, external auditors are inside the building asking for files nobody expected to explain. The floor changes its temperature. Conversations get shorter. People stop laughing near the coffee machine. Ericsson is placed on administrative leave, and nobody looks directly at you, because everyone understands what just happened. The position finally unwinds at a $47 million loss instead of $61 million, because the market moves slightly in your favor before the damage becomes worse. That tiny mercy saves the firm millions, but it does not soften the room. Ericsson is gone within weeks. You return to your desk, pretending your life has gone back to normal. Except normal now has teeth. Then your phone rings, and the voice on the other end belongs to a man you have never met. His name is Joven Vesteros, and he speaks like someone who has never had to prove he belongs in a room. He works for the government petroleum fund, the $1.4 trillion machine that owns pieces of companies all over the planet. He says there is an opening in quantitative risk. He says you should think about it over the weekend. Like people casually receive invitations to step inside one of the largest pools of capital on Earth. That sentence tells you everything. You start on a Monday in January with a new badge, a new building, and numbers so large they feel fake at first. Your badge says analyst. Quantitative risk. And for 8 months, that is exactly what you are. You build factor models. You decompose portfolio variance. You analyze risk without touching the controls. Around you, people discuss $800 million decisions in the same tone someone else uses to choose lunch. And you realize scale can numb the human mind. What changes you first is not the money. It is the patience. This fund does not jump because an analyst downgrades a stock. It does not panic because earnings disappoint. It absorbs, waits, and holds because it is so large that panic would become its own market event. You begin to understand something darker than confidence. Fear has not been defeated here. It has been structurally removed, and once you see that, money never looks the same again. Level 3 begins when you realize the fund is not fearless because the people are brave. It is fearless because the structure does not allow ordinary fear to enter the room. Markets open, markets close, crises flare, headlines scream, and the machine keeps breathing at the same rhythm. You are still just an analyst, still outside the real decision, but your old understanding of money is already dying. You used to think capital was something people controlled. Now you see it can become something people serve. By year 3, your title changes, and with it, the shape of your life inside the building. You are no longer only building models in the background. You are in the room when allocations are discussed, not at the table yet, but close enough to see how decisions are really made. And it is nothing like graduate school promised. Every number has a relationship behind it. Every relationship has history. Every history has a scar someone remembers or dangerously forgets. The head of equity is a Finnish woman named Pai Lati, and she controls $620 billion with the calm intensity of someone who has never needed to raise her voice. She is brilliant, precise, and absolutely willing to make powerful people uncomfortable. One afternoon, a $2. 1 billion infrastructure allocation is moving toward approval. The room is warm, confident, almost bored. Then Pai asks one question about the counterparty model, and the entire deal begins to die. The model was built by a consultant connected to a Dutch pension disaster in 2019. Most people in the room have forgotten that. Pai has not. She remembers the firm, the assumptions, the failure, the hidden weakness beneath the polished slides. In 40 seconds, she kills the allocation. Nobody argues. Nobody even tries. You watch the room accept memory as power, and something clicks inside you. If the institution forgets, someone has to become its memory. You start building your own archive. Every deal, every consultant, every model, every failed assumption, every quiet warning that never makes the final deck. You fill 3 notebooks in 3 months, indexing the things nobody asked you to keep. These are not secrets exactly. They are worse. They are context, and context is what powerful rooms lose first. At first, it feels obsessive. Then one afternoon, that obsession becomes your weapon. After 6 months in that room, you are not the same kind of analyst. You cross-reference 7 years of fund record, tracing names, decisions, structures, patterns nobody has bothered to connect. You begin to see the hidden map under the official one. Certain consultants appear right before bad outcomes. Certain models survive because no one remembers why they failed before. The archive grows, and with it, your value becomes invisible but undeniable. Then Pai asks you a question in front of the full room. Not your manager. Not the person beside you.
You.
The air tightens because everyone understands what a direct question means from her. You answer from memory, from notes nobody requested, from patterns nobody knew you had been collecting. You mention the year, the model, the prior failure, and the risk buried under the new proposal. Pai looks down at her papers, nods once, and that single nod changes your career. After that, the room looks different. The table you are not sitting at feels closer. People still do not praise you, because rooms like this do not waste words on praise. But they pause when you speak. They look at you differently when a name appears in a deck. You keep remembering. You keep indexing. You keep becoming useful in the most dangerous way possible, not because you know the numbers, but because you know what the numbers are trying to hide. Level 4 begins in year 5 when you become portfolio strategist for real assets. You are no longer watching the table from a careful distance. You are now part of the machinery that directs $74 billion into things people cannot simply sell by Friday. Infrastructure, real estate, timberland, unlisted equity. These are not trades. These are structural positions. They do not flicker on a screen. They enter countries, cities, ports, grids, and water systems. You take a 40% equity stake in a Chilean desalination consortium. You take a ground lease on the Rotterdam Port Logistics Complex, locking in decades of duration. You become a cornerstone investor in a Kenyan renewable energy developer that may one day represent 18% of Kenya's national grid. You expected power to feel clean, maybe even thrilling. Instead, it feels like your signature has entered lives you will never see. And that realization does not let go. On a Sunday morning, the Chilean consortium raises water prices, and by lunch, an NGO report is already moving through inboxes with your fund named inside it. The report says foreign ownership is extracting from ordinary people. You read every word, not because you are sentimental, but because every sentence can become regulation, protest, headline, or lawsuit. You model reputational risk, then regulatory risk, then replacement cost, and the coldest number wins. Replacing the position would cost $2, $3 billion. That is the number that decides the conversation, not outrage, not guilt, not the faces in the report. You recommend a $14 million community investment program, and the fund approves it. The move looks generous from the outside, but inside the building, everyone knows the truth. It is risk management wearing the clothes of morality, and you are no longer sure which version is more honest. By the end of year 5, you understand that every position touches someone who will never know your name. A port worker in Rotterdam, a family paying for water in Chile, a village connected to power in Kenya. You manage $74 billion with the same discipline you once used on $4. $2 billion, but the feeling is different now. Scale does not change the question. It only makes the answer heavier. What is the real risk here, and who pays when you are wrong? Level 5 begins in year 8, when the call does not come from inside the fund. It comes from the ministry. Minister Solberg offers you deputy CIO, but she says it like a question that has already been answered for you. You accept because refusing would feel like stepping off the only road your life has been building toward. You also understand something else immediately. Sleep will never fully belong to you again. The CIO is a Dane named Thorvald, one of the few living people who can sit at this level without sounding impressed by himself. You study him the way you once studied spreadsheets, patterns, delays, tolerances, blind spots. He does not teach directly. He reveals by deciding. You learn the first lesson fast. At this scale, capital does not really move through markets. It moves through relationships, and every relationship has a price nobody writes down. You sit across from the CFO of a global bank while $90 billion in Tier 1 capital is being restructured. The room is polite, expensive, and tense in the way only quiet rooms can be. You push for board observer rights, fee transparency, and an ESG covenant stronger than anyone expected to accept. Nobody calls it pressure because pressure at this level wears a suit and speaks softly. Before anything is public, the bank's stock rises 4% on rumors. Level 6 begins when you stop observing the machine and start running pieces of it. You manage the $1, 4 trillion liquidity framework. Every assumption, every correlation, every emergency scenario that says what happens when the impossible tries to arrive on schedule. Thorvald makes decisions you cannot fully follow yet, but you file them away. You have learned to trust delayed understanding. The pattern always appears later if you survive long enough to see it. Sleep becomes a managed resource. You schedule it the way you schedule currency hedges. Carefully, defensively, never assuming the position is safe. Your personal calls decrease. Your marriage compresses into calendars, travel windows, and messages that sound practical because emotional ones take too much time. You notice the cost, but you also notice that nobody is surprised. At this level, personal cost is not an accident. It is part of the design. Then one afternoon you sign a $2 bill. $2 billion allocation in 5 minutes. 5 minutes? The number should make your hand slow down, but it does not. A billion has become a unit of measure like basis points or duration. That is when the danger becomes real. Not because you are reckless, but because the scale has stopped feeling unnatural. The most dangerous transition is not fear. It is adaptation, and you are adapting beautifully. By the end of year 8, Thorvald tells you something he has never said to anyone else in the building. He is giving 18 months' notice. Nobody outside this floor will know for 6 months. The external candidate list is long, polished, and impressive. But you watch it shrink name by name. You do not celebrate. You do not relax. You simply understand that the chair is moving closer, and chairs like that do not come empty. Level 7 begins with a 4-minute call from Minister Solberg. No ceremony, no dramatic speech, just a controlled voice confirming what the institution has already decided. You are now CIO of one of the largest sovereign wealth funds on Earth. You are 41 years old, and your personal phone shows 12 missed calls you do not have time to return. Power does not arrive as freedom. It arrives as a narrowing of what you are still allowed to be. From the outside, it looks like you control the room now. From the inside, it feels more like the room has finally swallowed you. Every conference appearance, every public letter, every annual meeting vote is parsed by markets, ministries, competitors, journalists, and governments. You stop attending conferences, and even that becomes a signal. People analyze your absence like a statement. You learn quickly that visibility is not the same as authority. The network that helped lift you into the chair begins to contract the moment you sit in it. People who once spoke freely now choose their words carefully. Friends become cautious. Old colleagues become strategic. The number of people who can tell you the truth drops below 20, and you know it will keep shrinking. You used to think leadership meant more access. Now you understand it means fewer honest voices and more polished lies. You sign another $2. $2 billion allocation without hesitation, and somewhere in your mind, a small alarm goes off. Not because the deal is bad, but because your body no longer reacts to the number. The dashboards show amber warnings. Markets press against your assumptions. The ministry watches. Competitors watch. Every move you make is priced before it is understood. The chair has not made you permanent. It has made you exposed. Your marriage becomes logistics and calendar. Flights, calls, quiet dinners cut short by market updates. You both understand what has happened, but neither of you says it clearly, because saying it would make it harder to keep going. Then for a brief, dangerous period, the illusion forms. The illusion that because you control so much capital, you might control the market itself. The market corrects that illusion without emotion. Level 8 begins in your second year as CIO when a G20 economy enters a sovereign debt crisis. The market has already priced default. Headlines are brutal. Traders are leaving the country for dead. But your models tell a different story. Illiquid, not insolvent. That distinction is small enough to hide inside a sentence and large enough to be worth billions. You have $18 billion in dry powder and suddenly patience becomes a weapon. The dry powder came from a rebalancing Thorvald approved 6 months earlier, reluctantly, when nobody felt comfortable holding that much undeployed capital. Now that discomfort becomes optionality. For 4 days, you run scenarios until the edges of your thinking blur. Every model comes back to the same conclusion. The country does not need rescue from collapse. It needs time. And if permanent capital can survive the panic itself becomes mispriced. You deploy quietly across 11 trading days, 3 tranches, $6. $2 billion total. Not enough to rescue a country. Enough to say something without speaking. The fund sees value where the market sees ruin. Other institutional buyers notice. They follow. You release no statement. You give no interview. The position does the talking, and the silence around it makes the message even louder. Then the IMF package lands on better terms. The country does not default. Yields reverse. The position marks up $1. $1 billion unrealized, and from the outside, almost nobody understands how close the moment came to becoming something else. There is no victory speech, no public celebration, no headline saying you were right. Acknowledging it would require acknowledging how much you moved. So the win stays buried inside filings, dashboards, and a room full of people who know exactly what happened. 14 months later, the mandatory disclosure triggers a legal review from the Ministry Council. The position was expected handled within mandate technically allowed, but that word technically does all the work. The review is not punishment. It is structural. The question is not whether you broke the rules. The question is whether the rules should still allow someone like you to do what you just did. Level 9 begins when you read the legal opinion on a Tuesday evening and feel no relief. Intervention within mandate. Parliamentary review required. Structural, not punitive. The words are clean, official, almost gentle, but you understand what they mean. You prove the edge of the mandate. And by proving it, you made sure the next CIO will operate with less room. You did not break the system. You showed the system what it had accidentally allowed. That is the reckoning nobody warns you about. Winning can shrink the future. Your position made money, helped stabilize a crisis, and proved the fund's power. But it also forced the political world to look directly at that power. And once they see it, they cannot unsee it. The rules begin to change because you were right too visibly. You sit there with the opinion on your desk, realizing success has consequences failure never could. Markets open in Tokyo in 4 hours, so the world gives you no time to process any of this. There is always another open, another country, another currency, another board vote, another risk pretending to be isolated. The fund now holds $1, $4 trillion across 228 companies in 73 countries, and every one of them wakes up tomorrow with its own problems. You are responsible for a machine too large to ever be fully asleep. The liquidity framework assumes no single event will force simultaneous liquidation across 4 asset classes. That assumption has held for 19 years. You stare at it longer than usual because assumptions do not become true just because they survive. They become dangerous when people start treating survival as proof. Somewhere inside the framework is a sentence everyone trusts because it has never failed. And that is exactly what makes it feel haunted. Then the quant team flags a correlation breakdown in the real asset sleeve, tracing back to 2017. At first it looks technical, almost harmless. A pattern, a shift, a relationship between assets that should not be moving together but now does. You keep reading and the feeling returns before the logic does. Oslo, 11:48 p.m. A spreadsheet that should have held. A hidden constraint. A small warning before a large loss. You know this smell. Level 10 begins when you open a new analysis window and start building a model the way you always have. Not as CIO, not as the person markets watch, just as the analyst who once trusted the quiet discomfort in his stomach more than the confidence of a room. The scale has changed everything except the nature of risk. Risk still hides in assumptions, in shortcuts and cells formatted to look harmless. Risk still waits for tired people to blink. Somewhere below you, a junior analyst is running a stress test that will not be resolved until morning. You do not know her name yet. She does not know you in any real way, except as a title, a signature, a person whose decisions arrive from above like weather. But you know the pattern. Someone lower in the building is always seeing something first. Someone unnoticed is always closest to the first crack. That used to be you. The fund will outlast both of you. It existed before your bad, before your title. Before your marriage learned to survive in calendar blocks and unfinished sentences. It will continue after you are gone, after another person sits in your chair, after your best decisions become footnotes and your worst ones become lessons. The capital is permanent. The people are not. That rule is simple, brutal, and impossible to negotiate with. The The parliamentary review opens in 3 weeks. The correlation flag is still unresolved. Somewhere in the world, another crisis is already forming, probably in a place your dashboard still marks as stable. You are powerful, but you are not safe. That is the final truth the chair teaches you. Power does not remove uncertainty. It only makes the consequences larger when uncertainty finally speaks. And it always speaks. Tomorrow, markets open again, indifferent to your title, your sacrifice, your archive, your wins, your marriage, your sleepless nights, and the $1, 4 trillion machine you help command. Tomorrow you sit back down and begin again because every resolution opens the next problem. The game does not end. It only changes levels. And somewhere below you, someone is staring at a spreadsheet that does not hold.